Okay, so we're done with income statement, balance sheet. What next? Cash flows. So cash flows, as the name suggests, we only record whatever is the cash that we have received, what is the cash that we have paid. So what are the three different kinds of cash flow statements that we have? Cash flows from operating activities, investing and financing activities, right? So cash flow from operating, as the name suggests, whatever cash that we receive and pay for the basic operations of the company, right? So here we will have what are the various cash inflows and outflows that we have. Cash flow from operating activities. What are the inflows that we have? Inflow of cash from basic operations of the business, sales, cash sales that we have done, and what are the other source of inflow? Any sales that you had done in credit in the past. So accounts receivable, whatever you had collected now, collection of accounts receivable, that will be your cash inflow. What are your cash outflows? The expenses, the salaries that you pay, the interest that you pay, whatever the AP, accounts payable that you were supposed to pay, payment to the suppliers, all those are your cash outflows. Cash inflow is whatever you've collected from the customer, whether it is through direct sale or any kind of credit sales that you had done. All those are your cash inflows and outflows. Cash flow from investing activities. What are your inflows and outflows here? So when I say cash flow from investing activities is nothing but for the various investments that you've done in the company. So generally CFI will come from the asset side of your balance sheet, generally fixed assets. So here the basic cash outflow is investment that you've done to buy any property, plant and equipment. That's the major source of your cash outflow. What is your cash inflow from CFI activity? Sorry? Interest. Okay, that's a good point. But interest we might record it as either part of CFO or CFI. So again there is a difference how IFRS records is, how US GAAP records is. Interest expense, interest income, whatever dividends that we pay, all of those things. So we'll get into those details and those confusions when we do cash flow statement chapter. But generally what the cash inflows is, if you have done any sale of asset and you've got any gain on that sale of asset, that will act as your cash inflow. Okay. CFF, what will it have as your inflow or outflow? So cash flow from financing activity is again basically from the liability side of your balance sheet. How are you raising your finances? What are the various sources through which you are raising capital for the company? So here the cash inflow can be the capital which is raised. Either you've issued equity or if you've issued bonds or if you've taken any kind of loans. Those are your cash inflows. What can be your cash outflow? You can pay, say dividend paid. Yeah, so again dividend paid, US GAAP records it as part of CFF, but IFRS says you can record it as either part of CFF or CFO. So again we will not get into details of that, but dividends can be one of the cash outflow. What else can it be? If the company has done any share repurchases, even that can be part of CFF, right? So CFO generally comes from your income statement, what are the expenses and all, and generally come from your current assets and current liabilities. because if your AR has reduced, that will act as a cash inflow, or AP has reduced, that means it will act as a cash outflow. We'll get into details of that. So CFO, there are two ways in which we can calculate cash flow from operating activities. One is direct method, another one is indirect method. Direct method basically means is we just take into consideration from income statement what are the cash that we have selected, what is the cost of goods sold. So that is, we start from revenue as the top line. We start from the top line. Indirect method is we start from the bottom line. We start from net income and then we do certain adjustments to that to see what is the actual cash that we have collected, and both the ways we get the answer will be the correct. The CFO will be the same, but it's just that how do you record it or how do you prepare the financial statement matters. Direct method, indirect method. So again, in IFRS and US GAAP, there might have certain specification that which method is allowable and which method is acceptable. Indirect method is you start from the bottom line, which is net profit, and to that you do adjustments to come up with what is your cash flow from operating activities. Direct method is you start from the top line, which is your revenue. Okay. Okay, tell me one thing. Why is cash flow statement so important? Does cash flow statement gives you more information about the company's solvency, profitability, or does income statement gives you better information? Which one should you look at more, and which one gives you more information about the company's sustainability, either income statement or cash flow?
Cash.
Why?
Because it shows how the cash flow is.
What is the liquidity position of the company? So there is a possibility, or is there a possibility that the company is showing positive net profit but the CFO is negative?
You can't hide things.
Sorry?
You can't hide things.
You cannot hide things, yes, but cash flow actually tells you what is the cash inflow and outflow that has happened, what is the actual cash movement that has happened, right? If you have made most of your sales on credit, right, then it will show that your cash flow CFO is negative because you have not received any cash against that. It will just keep increasing your AR, right? But profit might show positive because you have done a lot of sales, but will that convert into cash or no is a question mark. So that's why cash flow statement gives you more information about the company's liquidity position, solvency, sustainability than the income statement, because income statement again is based on accrual accounting, based on matching principle, wherein they record expenses that they have still not incurred, they will record revenue which they have still not received as cash. So that's why cash flow statement is more important, gives you more information about the company's future profitability also, right? And within all the cash flows, CFO is given most emphasis, because that tells you is the company able to generate enough cash flows through its business operations. CFI can be negative if the company is doing a lot of capital investment, and CFF can be positive or negative depending on is the company raising more capital or no. But CFO we always want it to be positive, right? A positive CFO tells a lot about the company's financial position, right? If the CFO is positive, that means the company is able to generate enough cash flows through its various business, through its day-to-day business operations, right? So whatever is the balance of this, so we start with opening balance of cash flow. So where does this opening balance of cash flow comes from? So these are the changes in cash flows that we will record. Where does the opening balance of cash flow come from? Cash comes from the balance sheet, whatever was the last year's cash, closing cash. Then we will do all these calculations and record the changes in cash balance. We will record whatever is your CFO, CFI and CFF, and whatever will be the balancing figure will be your closing cash flow. And where will we record this? Closing cash balance, where will we record this? Again in balance sheet. So whatever cash that you see in your balance sheet, this comes from the cash flow statement. Through that, whatever is the balancing figure, this will come here. It can be positive or negative. Yeah. So we're done with income statement, balance sheet and cash flow statement. So when you look at any company's financial statements, apart from these three statements, what else do you look at? What else is provided by the company? Apart from the financial statement, income statement, balance sheet, cash flow, what else is part of company's annual report? Sorry? Trading account. Not every company will have that trading account, and trading is a completely different line of business that the company has. So if the company is into manufacturing, they'll obviously not have trading account. What else is part of company's financial statements, or what else is part of company's annual report? We have footnotes. What are footnotes? Financial footnotes. So say if I have recorded revenue as 100,000, where did this revenue come from which segment? So in income statement I will not give basically segment wise data, I will give the total balance whatever I have, right? So where does this 100,000 come from which business line, from which geography, all those will be given details in the footnotes, right? If the company have say 5 different kinds of fixed assets, so they will have depreciation for all of those separately, which they might provide again in the footnote. So footnote is basically a supplement to the financial statement, wherein it gives you details about how each line item is recorded, whether it is revenue, cost of goods sold, various expenses. Again coming to the balance sheet, what are the various assets, how have they calculated depreciation, what is the accumulated depreciation that the company has. So all of those details, the in detail description of how each line item has arrived at are given, the details of those are given in the footnotes of the company. And also in the footnotes they will also mention which accounting method are they using, what are the various accounting principles that they are following. If they are recording inventory, which method are they following, LIFO, FIFO or whatsoever. If they are recording any kind of asset, which method are they recording, are they recording those assets based on their historical cost, depreciation cost, all of those costs. So again, now that I have introduced that, so what are the various ways what are the various ways we can record each of our balances of assets or any kind of expenses. So we can record it at its historical cost. Say if you've got a land 20 years ago, which you've got it at say 50 lakhs, will the value of that today will be the same? No, but we might record it at a historical cost, at what price we bought that land at that period of time. Or we can record certain assets at their amortized cost or depreciable cost. That means at whatever price we got that cost minus its depreciation value, and what is the carrying value of that asset is amortized cost minus depreciation, will record at that price, whether amortized cost for intangible asset. Or we can record it at its current cost, like the land. Again we might say revalue that asset and see whatever is the current cost that we can realize from, if we were to sell that particular asset, we can record it at that, or we can record it at its realizable value. What is realizable value? Any idea? So realizable value is nothing but, say if you have inventory worth 10 lakhs in your warehouse, if you were to sell it, you will receive 10 lakhs against that, worth 10 lakhs. But there might be a possibility that that inventory might turn obsolete, and you might not be able to recover all of that 10 lakh, you might be able to recover only 9 lakhs out of it. So that 9 lakh is the realizable value. If you were to sell that inventory today, what is the amount that you will realize from that inventory? So in inventory chapter, we will learn how do we calculate the realizable value in IFRS and in US GAAP. Next, we can record certain assets as its present value. What is present value? So if there is an asset that will give you cash flows in the future, you will discount it and calculate its present value. We have done that in fixed assets, right? And time value of money also in quants we have learned how to calculate the present value. So there are certain assets or certain entries in financial statement which we can record at its present value, or finally we can record it at its fair value. Fair value means if you were to sell that asset today, what is the amount that you will realize by selling that asset. So current cost and fair value, what is the difference? Or current value or fair value, are those the same or is it different? Sorry? Okay, how? Actual book value. No, book value, fair value are completely different. So current cost is, say the land that you got at 50 lakhs, if you were to buy that today, how much will that cost you? Fair value is if you were to sell that today, how much is the value that you will realize out of it. So if I had got, say, an apartment, maybe if I were to buy that, the cost will be different, but if I were to sell that, the cost will be different, right? So fair value is if you were to sell any particular asset, what is the value that you will get out of it and what is actually the market price of that particular asset, we can say that will be the fair value. So different assets are recorded at different values depending on again different industries, different companies, they might record its current cost or depreciable value or historical cost or fair value, and different kinds of assets are recorded at different ways. Like inventory is recorded at realizable value, your fixed assets are recorded at their amortized cost, right? Certain like your marketable securities which you can buy and sell in the market, those might be recorded at their fair value. So different kinds of assets are recorded at different ways. What is the different methods that we have? Okay, yeah, coming back to footnotes. So footnotes is again gives you details about how each accounting method is recorded and also how did they arrive at that value. So sometimes, say generally US companies, they don't show depreciation on the face of the income statement. Where do they record it? Any idea? They basically record it as part of your COGS. So they remove it from there rather than showing at the face of your income statement. So if you were to say calculate cash flow statement, you might want to know what is the depreciation amount to remove that, because that's a non-cash charge. Again, if you don't understand it, when we do cash flow statement, you will understand it. Yeah. So those details of how the depreciation is recorded, where it is recorded, again those details you will find in the footnotes of the company's financial statement. So for an analyst, just looking at the financial statement doesn't give you any information. Footnotes is where you will emphasize more, get into details of what are the revenue drivers of the company, what are the various cost drivers of the company, which accounting method the company is using, from where are the company getting their cash flows, is the company sales mostly on cash or credit, what is the company's liquidity position, working capital position. All of those details you will get from the footnotes of the company's financial reports. Next, what else do you find in the company's annual report? Footnotes, yes. What else? Have you heard of this? What is management discussion and analysis? What do they provide? What details do they provide in MD&A?
So it's usually from the management saying how the company has performed and how the macro conditions are.
So it is basically the message from the management of the company. They basically tells you that what the company's future prospects are, where are they planning to invest, how the macroeconomic variables has impacted the company in the past, how will it impact in the future, right? So as an analyst, what we told that we are basically forecasting the company's future financials, looking at the company's future profitability, and based on that we are deciding today should we invest in that company or no. So MD&A, so whatever we have learned, income statement, balance sheet, cash flows, does it tell you any details about the future? It tells you until now, present, how the company is performing. But MD&A, through the management discussion, they tells you what is the future look like. They basically tell you that what are the various projects that we might invest in, or what are the various
Like what are the next quarter's expected margins?
What is the various other changes that they might do, or what are the various externalities that might impact the company if there has been certain changes in the regulations and all of those things in that particular industry. How is it impacting the company's financials, so on and so forth. All those things are given details about that in MD&A, and MD&A acts as a major source for any analyst to project the company's future financials. They might also tell that what are they expecting the company's sales to increase, at what rate are they expecting the growth to happen, how are they trying to reduce their cost as much as possible, or if their cost is increasing, how will it impact the future profitability of the company. All those details they provide in MD&A. So just looking at the company's financial statement, income statement, balance sheet, cash flow doesn't give you enough information. You need to get into the details of footnotes and MD&A to have a holistic view of how the company is been performing and how the company will be performing in the future. And again, that will help you to do a comparison of forecasted versus actuals, to see is the company living up to whatever they are promising or whatever they promised in the past. Is the company able to replicate what they thought that they will have as a growth? If they committed that we are expecting to grow at 10%, did they actually grow at 10% or no? So all those details you will get in MD&A, which is again thought as one of the major source of information about the company's future property. So these are the details that you get from the company's side. So are there any other source of information that you can access to look at what is the company's future prospect look like, or what is the company's next quarter or next couple of years look like? So this is what the company has published. Is there any other source of information that we can look at? Industry report. A lot of third party reports are there. Various government also publish any kind of industry report, or if the company has done any kind of commentary or any kind of transcripts of the company, we can find that. Or if the company has any kind of interview, those details you can look at, or any kind of third party that might provide you information about the company. So just the company's financial report is not the only source of information for you as an analyst. There are various other sources of information which you can use in conjunction with the company's annual report and then come up with your report about the company. So this is basically, I am telling you how do you research a company and how will you come up with a report about that particular company and what will be your recommendation based on that. Will it be a buy recommendation for that company? Will it be a hold if you are already an investment holder, or will it be a sell? That's the bottom line of any report, research report that you prepare. Okay. So now let's look at, there are again a lot of prerequisites we have for other chapters, in which major is your inventories. Just give me one moment. Major is your inventories, right? So when we talk about inventory, what all does it impact in your financial statement? It impacts your cost of goods sold, and it impacts your inventory, which is your closing inventory in your balance sheet. So it impacts both your income statement and your balance sheet, right? Inventory impacts both your income statement and your balance sheet, right? So are you aware what are the different ways in which you can record inventory in your financial statements? Ever heard of what is LIFO? Last in first out. FIFO is first in first out. Next one is weighted average cost, which comes in between LIFO and FIFO. So now we know the abbreviation, but what does LIFO actually mean? Last in first out means whatever latest that you have purchased, that you will sell first. First in first out is whatever you had purchased chronologically, you will sell those first. Again, to understand it intuitively, we are not telling which asset or which product that we are selling. Say if we are into a sales of say water bottles, so can we identify which water bottle we bought in January, which in Feb? No. So we know this is the inventory. So LIFO, FIFO is used just for recording purpose, just for accounting purpose, and not to say which unit that we sell. But when we sell automobiles, so each automobile will have their respective codes. So there we know which automobile we actually sold. But when it comes to water bottle, we can't, right? So last in first out, first in first out. So all of these will impact your cost of goods sold and your ending inventory, right? So if it is last in first out, whatever is your latest purchase. When I say latest purchase, say you are into selling of again water bottle. So at the say April 1st of April, you will have say 5,000 worth of water bottles with you, right? Then during the year you will do certain purchases. Say in May you did certain purchase, then in September you did some certain purchase, then in November you did certain purchase, then in January you did certain purchases, right? Say all of these purchases that you do, and from this you will reduce whatever sales that you have done, and this will give you your ending inventory. So let's do this in terms of number of units. So say we have 100 bottles with that already, and during the year we say got 50, 60, 80, 90, and we say sold 300 bottles, and each of it we would have got a different price. Say the inventory that we had, we procured that at 120, but due to inflation, maybe the one which we got at May, we got it at 125, we got it at 130, say again we got it at lower price, we got it at say 135, possible, right? So when we are recording our cost of goods sold under LIFO and FIFO, Under LIFO, whatever is the latest purchase, we will record that as cost of goods sold. Under FIFO, whatever is our older purchases, we will record that as cost of goods sold, right? Because of that, will it impact our profitability? Will it impact our net income? It will impact our net income also, right? So let's do a small problem and understand this. How will it impact? So generally inventory, we start with opening inventory. Plus purchases minus cost of goods sold will give you your closing or your ending inventory. So out of these four, if one of them is not given, can you calculate that? If you've given opening, closing and cost of goods sold, can you not calculate purchases? But now we will basically, through this inventory question, we will be learning how to calculate cost of goods sold and how to calculate your inventory, ending inventory, right? Cost of goods sold, which is part of your income statement, ending inventory, which is part of your balance sheet. Yeah. You have noted this down? So now let's just create a small table to understand this method, cost of goods sold and your ending inventory, and how will it impact your profit and your inventory. Okay, considering we are doing LIFO method, first in, first out. So what will be recorded as our cost of goods sold? Will be the initial purchase that we have done, the purchase that we have done in the past. So will come as a chronologically what purchases we done first, we will consider that as sold first. So we will consider that as our first purchase or initial purchase. Next, coming to our ending inventory will be our most latest purchases, whatever we were not able to sold. So basically, so out of this, if we have sold 100 units, so we might have sold until here and maybe we were left with 90 units. So 90 into 135 will be our ending inventory, our most latest purchases. So this is our latest purchase. We'll come to that later. Let's do this first. Next, coming to LIFO, last in, first out. So our cost of goods sold will be whatever we have purchased latest, we are considering that as sold first. We come from bottom up, right? Latest purchase, we come from there. So we will look at what is our most recent or latest purchase. We will consider that as our cost of goods sold, and our ending inventory will be our initial purchases. Old inventory will be our initial purchase, and weighted average will be in between both of these. Generally will be in between both of these. Okay, so let's do a question. I'll give you a few numbers and let's calculate what will be its cost of goods sold and ending inventory. Say consider a company which has its opening inventory of 10 units that they got at $20, right? And they did purchases in the month of say so we'll consider Jan to December business cycle. March, September and November they did 3 purchases. They got 20 units again at the cost of 22. They got 40 units at the cost of 24 and they got 10 units at the cost of 25, right? So overall how many units do they have? 30, 40, 70, 80 units, right? And maybe out of this sorry, 1 minute. So we have another December wherein we got another 10 units at 25. So we have 90 units and out of that say we sold 80 units at the cost of $30. We sold 80 units at the cost of $30. So now tell me what will be our cost of goods sold and ending inventory in FIFO. How will we calculate that? So if we have sold, so this is our revenue at $30. So we need to calculate what is our cost of goods sold. So under FIFO we will take our cost of goods sold to be the initial purchase. So we'll do 10, 30, 70 plus 10. So 10 into 20, 20 into 22, 40 into 24 and 10 into 25. Calculate that and tell me what is our cost of goods sold. Wait a minute, let's take this as 30 so that we make it little difficult. So we have sold 80 units. Tell me the cost of goods sold under FIFO and what is our ending inventory under FIFO. हाँ बोलो बोलो जो कतरा फोन किता के मना थन ठाए नि मु क्लास में वो उतरा फोन करो थे मना क्लास लाती लाती फोन और किधर में थाना done with the calculation. What is our cost of goods sold? Sorry? Spurti, you got the same number? So how will we do? We've sold 80 units, 10 into 20, 200, 20 into 22, then 40 into 24. This will be done with 70 plus 10 into 25. So what is our ending inventory? Huh?
Cost of ending.
Yeah, cost of ending inventory. Sorry? Minus what? No. Ending inventory is, say you started with opening. You sold a bit of it. Ending inventory is whatever is remaining with you. So we sold 10, all of it we sold under FIFO. March purchases we sold it all. September purchases we sold it all. November purchase we sold only 10 units out of this. So we are remaining with 20 units which we got at 25, and December purchases we have all of it 10 units at the cost of 25. So we are left with 750 is our ending inventory. Now tell me in terms of LIFO, what is our cost of goods sold? So LIFO we will start from bottom. So we will consider we have sold December, November and September purchase. 40, 30 plus 10, we have sold all 80 of these. Sorry? 1960. And our ending inventory will be 440 plus 200, 640. Check if that's the one. Ending inventory will be our March purchases and initial opening inventory, right? Last in, first out. So whatever was last in, 640 is our ending inventory. So this will be average. Let's not calculate this, that's not important. So the scope of CFA is to understand how does LIFO and FIFO impacts your inventory and your profit. Okay. So now considering, so LIFO our cost of goods sold is high, FIFO our cost of goods sold is low. Again the underlying assumption for whatever we are constructing here is we are living in an inflationary environment. That means cost is always increasing and the inventory levels are also increasing, or it is stable. We are not looking at decreasing level of inventory. Okay, these are the two underlying assumptions: inflationary environment plus stable or increasing inventory, right? So when our cost of goods sold is high, what happens? Cost of goods sold is low, what happens to our profit? It is high under FIFO. And what is our, how is our inventory? Inventory is also high because we are looking at the latest purchases. Under FIFO, since our cost of goods sold is high, our profit will be low, and our ending inventory, if you see, comparatively also is low here. So your FIFO method is allowed under both IFRS and US GAAP. LIFO is allowed only under US GAAP. IFRS don't allow you to do it, right? Because generally FIFO gives you better details than LIFO, right? Because LIFO, your cost of goods sold is the latest purchase, your ending inventory is very old purchases, right? So LIFO is not basically allowed by all the jurisdiction. FIFO is generally universally accepted by majority of the companies and the reporting standards also, right? So in inventory,
LIFO is not allowed by
IFRS. LIFO not allowed by IFRS. FIFO is allowed by both US GAAP and IFRS. LIFO, US GAAP we can use both FIFO or LIFO. IFRS only FIFO. Okay. So generally the scope of inventory chapter will be in what case your profit will be high, in what case your inventory will be high, how do we calculate the realizable value of an inventory, right? Which method is acceptable, which method is not acceptable. We will also learn something about LIFO liquidation, LIFO reserves, all of those things we will learn it when we do the chapter. Yeah, any questions until here? Good. So considering today is the first class, we'll keep it light. So these are the major prerequisites that we have before we start FSA. So next week we'll start with the first chapter. Okay.